Good morning, good afternoon, and good evening to all of you. We've got registrations from over 80 plus countries for today's webinar. And thank you so much for joining us today. I'm Garima from QuantInsti, which is a pioneering algorithmic and quantitative trading research institute, where we are empowering individuals across 160 plus countries through our educational initiative. Our speaker is Dr. Alexis Stenfors, the author of Barometer of Fear, an insider's account of rogue trading and the greatest banking scandal in history. But he's not only an author, but also an economist, a public speaker, a financial consultant, but most importantly, he's a trader at heart. He holds a civil economy degree and an MSc in financial economics from the Stockholm School of Economics, a CEMS master, as well as a PhD in economics from the SOAS University of London. He has spent 15 years of his life as a foreign exchange and interest rate derivatives trader at HSBC, Citi, and Merrill Lynch. And currently, Dr. Stenfors is a senior lecturer in economics and finance at the University of Portsmouth. Let's start with the presentation. Dr. Alexis, over to you.
Welcome, everybody. This is Alexis here, and thank you so much for checking in. Today, I will be talking about the FX market, and the focus of this talk is really on liquidity, which I think is extremely important when you look at any market, but perhaps FX market in particular. And I want you to sort of listen to this with respect to, or as a comparison to the stock market, because I know most people are very familiar with the stock market, and actually very few know much about the FX market. And I think that is something that you need to bear in mind. The starting point of this is really to highlight in the beginning why the FX market is special. And I'll then move into to talk about liquidity and how liquidity has changed with the rise of algorithmic trading. And I'll show some of the results from the research that I've done and then conclude. So without further ado, let me start. One thing that makes the FX market special is, of course, the size. It's incredibly large. The turnover is around $5 trillion per day. And it's difficult to compare it to something because it's so incredibly large. So it's around 8 times bigger than the global stock market. Which gives you sort of perspective of how big this market is. And also, as you know, there are many different stocks out there, but rather few currency pairs. So if you think about that, the actual market for the major currency pairs is absolutely phenomenally large. And the second point is the liquidity. Liquidity in general is very, very good. So even during a crisis or a crash or a catastrophe, whether it's a natural disaster, the FX market tends to be active. And it's famously, of course, a 24/7 market. It doesn't stop, but of course it's closed during Saturdays and half of Sundays. But generally speaking, it is a 24/7 market. And the third point here is that it's competitive. And here I'm not talking about the retail market. If you go and buy some cash because you go on holiday abroad, you normally pay a very, very large spread or a commission. In the interbank market or for professional investors, there are no commissions really, and it's incredibly competitive. So I'm now talking about the professional market and not about the retail market at all. The second point is that this market is international per definition. That makes it very special. Think about Brexit, for instance. I'm now talking from London, and the only thing we discuss here is Brexit. Will the UK leave the European Union, and when will it do so, and on what terms? This affects the pound, of course. So if you want to bet or speculate or hedge against exposure you have in the UK, you are interested in the pound. But you cannot trade the pound without trading something else as well, which means that you always have to trade something else. It's pound against the dollar, pound against the Japanese yen, or pound against the Brazilian real, or whatever. So it's always an international asset, if you like. It's also a market with perfect symmetry, which is unusual. So what I mean here is that if you buy a currency, you automatically sell another currency. This sort of sounds obvious, and people don't really think about it, but it has an important implication. In the stock market, you know that most people tend to buy stocks, and you can also short stocks. Sometimes you cannot, but generally speaking, there's a bias towards buying stocks. In the currency market, this doesn't exist because you always buy one currency and you sell another currency. So the whole idea about going short a currency comes very naturally in the FX market. FX traders from the beginning learn that you can short a currency because that's what you do. Every time you trade FX, you short one currency. And another point here that is important is, of course, the link to states and central banks. The central bank has monopoly to print the money, which means that there are many countries still that have fixed exchange rate regimes, say Hong Kong, Denmark, or Saudi Arabia, and they try to keep the currency, the value of the currency within a certain range, or very, very fixed to some other currency. Others, like Bank of Japan, but also the Federal Reserve, they don't have fixed exchange rate regimes, but they do intervene sometimes, which means we don't use the term manipulate the currency. It's called intervention. But the state or the central bank actively go in and intervene in the market. And that happens quite regularly. And that is something you need to be aware of. Why did they do that? Well, it can be sometimes for political reasons. And sometimes they say that the market is too volatile, so they go in and intervene. Or sometimes they say that the exchange rate is fundamentally mispriced. So they would argue that the Japanese yen should not be this high, or the Japanese yen should not be this low. Therefore, we go in and intervene in the market. This is, of course, totally different from the stock market. You don't see states or governments intervening in the stock markets that way. Point number 3 is about regulation. It's also sort of famously unregulated market. So banks are, of course, regulated, banks that trade FX, and individuals working for banks and financial institutions are regulated. But the market itself is very lightly regulated or unregulated. It depends on the jurisdiction, but generally speaking, it is a very light touch regulation in the FX market. And another good point here, an important point, it's that there are no circuit breakers. What does this mean? Well, I think this slide here from the pound flash crash in 2016 is a good example. So this happened in October 2016. The pound fell against the US dollar during the Japanese trading hours. And of course, there was some algorithmic trading involved, which I'm not going to go into. But the point here is that if the price of a stock or an index falls, the exchange can pull a plug and stop trading for a while. This cannot be done in the FX market. So there's no circuit breaker in the FX market. So you need to be aware that if the market collapses or if the market soars, nobody will prevent it from moving further up or down, unless perhaps the central bank intervenes. But there's nobody who can actually pull the plug from the market. And the final point, point number 4 out of 4, is that this is a market that is not exchange traded. Even though it's phenomenally large, it is still a market where you trade with another counterparty rather than an exchange. So almost 98% is OTC. It's also a very opaque market. There's no exchange or institution that collects the data, so you can sort of access data and do your own research. It's tricky. It's very hard to get real-time price and volume data from the FX market for the public. And I think a good example is if you're an academic, or if you look at academic research and you look at equity or stock market research, you will find, I'm probably exaggerating, but you will find 100 times more research done on stocks and equity markets than on FX, simply because it's easy to get hold of data. For FX, it's very difficult. And finally here, which is going to be the most important aspect for this talk, it's that it's relationship-based. Traditionally, it is relationship-based, which means that traders talk to each other, or used to talk to each other. We will see that this has changed, but it is very important. Now, all of these 4 points, all of these points have important implications for how liquidity is provided in the market. If you work as a market maker, like I did for 15 years, so you quote prices to customers, you cannot quote a price to a customer without being able to get liquidity for somebody else. And that will normally be a bank. So if I quote a customer, I need to know that I can go to another bank, but that other bank also needs to know that they can come to me. So this creates this relationship that nobody can quote prices or provide liquidity unless they know that somebody else will quote them back. So there's no rule saying that you have to quote a price or that you have to provide liquidity. It's a convention. It's an agreement between the banks normally that some banks will quote some currency pairs or a range of currency pairs and others will not. And these change over time, of course, but generally speaking, it's a verbal agreement between the banks. And this is sort of the core of how liquidity in FX market especially, but also in other OTC market works. Now, what do I mean by liquidity? Well, using a definition by Kyle from 1985, you can divide up liquidity into 3 different types of liquidity, and I will use these just to illustrate what I mean. There is price-based liquidity, which means, well, how much does it cost to turn around a position over a short period of time? So if I buy sterling against dollar, and then I change my mind, and I want to sell it instead, how much will it cost? So that is normally measured using the bid-ask spread. Another measure is the volume. So how much can I actually buy? Can I buy 10 million pounds, 100 million pounds, or just 1 million pound without moving the market price? So here we can use, for instance, the market debt. How much can we buy or sell without moving the price? That is volume-based liquidity. And the third point is about speed. So if there is a shock, if the market collapses, how long does it take for the market to recover? It could be days, it could be minutes, it could be hours, or perhaps seconds. This is, of course, very difficult to measure, but that is the concept of speed-based liquidity. How long does it take for the market to recover? Let me give you a couple of examples how these are relevant for the FX market. So this is a paper that I wrote, it came out earlier this year, or last year in 2018, where I look at the bid-ask spread. So this is the price-based liquidity of, in this case, it's not the FX spot market, it's the FX swap market for US dollars against Japanese yen during 7 years. And I look at the prices posted by different competitors. These are 3 brokers, the 3 largest FX brokers in Japan, Tullet, Prebon, and ICAP. What kind of spreads did they quote to banks? And as you can see from just this graph here, there are 5,000 observations or something. You can see the clustering around even numbers, so 0.1, 0.2, 0.3, 1, and 1.5. This is, of course, standard in financial markets, that prices or spreads tend to cluster around certain digits. But that's not the interesting part here, the clustering itself. The interesting part here is that these three competitors often quoted exactly the same spreads rather than different spreads. And when they did so, they also tended to repeat this behavior the next day and the following day and the day after. And this is typical of convention, that you end up with a convention, say that you quote 0.5 as a spread, and you do the same the next day and the day after. That is a typical price-based liquidity convention. There are also volume-based liquidity conventions. As a trader myself, I remember that I could call a bank and ask for a very, very large amount for a price, 100 million, say, in spot. But that would normally be seen as the wrong thing to do. That is almost rude. Maybe in this particular market, 100 million was too large. Maybe it was 10. So there are also a number of volume-based conventions between the banks, but also between banks and customers, large corporates, of what is a reasonable size in a particular market? What is the standard amount? Is it 10 million, 5 million, 1 million, and so on? And you rarely deviate from these, unless it's a special occasion, but you don't do it on purpose because it's seen as the wrong thing to do. And you might think, well, do people really care? Yes, they do. In this market, you will normally be punished if you break these conventions. Punished by, say, the next time you ask for a price, the price will be wider, or you get a slower response. And if you think about electronic trading platforms, so for those of you who are familiar with electronic trading platforms and algorithmic trading, you think about, well, a price on a platform is valid if it's there. That's it. That's true, but in a human market, that is not always the case, because a trader or a market maker cannot quote and cancel prices all the time. It's physically impossible. So there are also conventions saying that, for instance, that a price is valid for a matter of seconds or a couple of seconds. And that is, of course, up to judgment. What is it 2 seconds, 3 seconds, or 4 seconds? But there are also these kinds of conventions that relate to time. Now, are these conventions important or not? And do professional traders actually follow them? The two surveys were done in the early 2000s, where hundreds of FX dealers and chief dealers for large banks were asked, why do you follow a market convention? Market conventions like the ones I just presented. And many people are shocked, those that haven't worked in the FX markets, how small the proportion of trading profits is here. Like, you might think that the only reason why you would follow a convention is to make money. It's greed or something like that. And as you can see, it's actually a very, very small percentage. Trading profits, maybe between 5 and 10% of traders would answer that the reason you follow a convention is to make money. And as you can see here, the key to why you would follow a convention is to maintain a relationship, a trading relationship. So that would normally be between competitors or between banks and customers. More than 50% would normally say that the reason why you follow a convention is to keep a good relationship with another bank. Or even, as you can see here, market image matters. Now, this was done in the early 2000s, and today it's 2019. A lot has happened since. So the question is, with the rise of algorithmic trading, do these rules still exist? And as we see, well, to some degrees they do, but they are changing. And of course, the stock market has seen a lot of influx of high frequency and algorithmic traders for a while. The FX market has been a little bit slower. But just to give an indication, EBS, or electronic broking system, which is the largest platform for banks and high frequency traders in FX, the share of algorithmic trading rose from just 2% back in 2004, and today it's over 70%. So that happened very, very quickly. Now, an electronic platform is not really a threat to convention per se, and it's quite normal for humans to communicate electronically like we do now. So that is not really an issue. What is interesting, though, is that algorithms, they are not really suitable to follow these conventions that are really meant for human relationships. And as you'll see here, that has implications for liquidity. So just to sort of brief recap of what is how do we conceptualize a high frequency trader, so a non-human trader, if you like. Normally, academics would tend to see them as extremely fast humans, like a Usain Bolt, extremely fast humans, which is a good thing, because if traders are fast, if the difference is simply about speed, that leads to more competition, and that leads to a higher efficiency in the market, ultimately lower transaction costs, tighter spreads, and better liquidity or discovery process when it comes to price, and ultimately better liquidity. So this, I guess, is for those that are proponents of high frequency trading, these are normally arguments that you'll see, that if we treat high frequency traders as fast human traders, then everything will be better. Now, traders that I talk to, FX traders that are still working in the markets actively, I've asked them recently, what do they think? What do they think about the development of the FX spot market from having been completely human to actually now being perhaps more and more non-human? And there are three anecdotes that I hear from a lot of traders that I think are very interesting and very important to look at. One is that the market moves as soon as you try to deal. So this is something that traders that use electronic trading platforms can be disappointed that if they try to deal or hit a price, and remember the FX spot market is a very fast market. FX spot traders are very quick traders, but even they feel that sometimes the market disappears, even though they wanted to deal. In normal situation, they would have time and something happens. Something is just faster than they are. The second thing is that liquidity, how they used to look at liquidity, is sometimes almost like an illusion, that what you used to see, if you looked at the screen and this was what you thought liquidity was, today it's more complicated. And they find it very difficult to sort of put the finger on what is different now, but it's different. And the third thing is that they, of course, sometimes try to find ways to spoof a high-frequency traders or algorithms. It's sometimes possible to find out ways, how do these algorithms behave or think, if you like. And this has almost become a habit among traders to sort of talk about how can you trick the algos. So regardless whether you sort of are pro or against algorithms, and this is not sort of the topic of this discussion, I think what both sort of camps agree upon is that liquidity is very important, and the FX liquidity is changing in the market. And regardless whether you are a human or an algorithmic trader, this is something you need to look at much more carefully. So let me go through a couple of examples of recent research that I've done with a collaborator in Japan, and we managed to access data from EBS, which is this large trading platform. And this here, I'm just going to show you a very sort of short snapshot of 3 trading days back in 2010. And these were completely normal trading days. They were not special in any way. But took it from 2010 also because that was when 50% was human trading and 50% algorithmic trading. So this gives you a good example of what does a market look like that is 50% human and 50% non-human. And I've selected 5 currency pairs. You can see here it's euro dollar, dollar against Japanese yen, euro against the Swedish krona, US dollars against Russian ruble, and US dollars against Turkish lira. So the first 2 are the 2 biggest currency pairs, and the other 3 are also quite large, so ranked number 11, 12, and 16 globally. Now, 3 trading days, and the total amount of limit orders for euro dollar here was 1.8 trillion. Imagine, this is a lot. This is really a huge market. And even, say, Turkish lira, which you might think, well, this is an emerging market currency, shouldn't be that large. Limit orders worth $38 billion just during 3 trading days. Now, by any measure, this looks phenomenally large. But if you look more closely at the euro Swedish, dollar against ruble, and dollar against Turkish lira, you'll see that there was absolutely no trading going on. So the total market order amount during these 3 trading days was 0. How is that possible? Well, the reason being is that for those 3 currencies, this is not the main trading platform. This is the number 2 or number 3 trading platform. So even though you can see a large number of limit orders, there was actually no activity in terms of trading going on during these 3 trading days. Now, let's look a bit closer at just the euro dollar, which is the largest currency pair and also, perhaps the largest asset class in the world. With turnover of more than $1 trillion per day. So for these 3 trading days, we had a limit order amount of 1.8 trillion, roughly, euros. And the bid-offer spread was 0.08%, which is incredibly tight. That was the average bid-offer spread on this platform. And the market depth was about 16 million euros. So at any moment in time. So this was a 24/7 market. So by any measure, you would say that this is a liquid market. If you turn around your position, you only pay 0.008%, which is almost nothing. It's very difficult to find any asset on the planet that has a tighter bid-offer spread. So logically, most people will say that this is a liquid market and this is a liquid market on this platform. But let's look a little bit closer. So it's still the same database, and here I've filtered the actual transactions here. So remember, the number of transactions here is, the number of transactions is about 9,000. And if we scroll back, we'll see that the number of order submissions was 1.4 million. So think about this, that only less than 1%, or even much less than 1% of all limit orders, if you look at them, how many actually did result in a transaction? It's a tiny, tiny amount. What we also see here is that the order size is rather small, 1 million. Well, 1 million is the minimum size on EBS. You cannot submit a smaller order. But 86% were exactly for 1 million. And yes, there were large amounts as well. 250 million was the largest order, but these orders are very, very rare. And another thing here is that the limit order lifetime. So how long does a limit order stay on the platform on average? On average, 44 seconds, but the median here is just 2.5 seconds. So yes, there are plenty of orders out there on the platform, but they are there for a very, very short period of time. I'll get back to the split orders later on. So far we can say, well, on the one hand, yes, the market looks very liquid. On the other hand, maybe it's somewhat less liquid than we think. So the question is, how quickly is liquidity withdrawn? What I'm thinking about here is, if traders that I know say that the markets moves as soon as you try to deal, is there some way we could check whether this is true or not? I've done a test here, and what I do is that I use the timestamp of each of these 1.4 million limit order submissions. So look at every single timestamp, and also work out the limit order volume on the platform for every single timestamp and the change over time. So the idea here is to test and see, if I submit an order to this electronic trading platform, what happens to liquidity in terms of volume in the very near future. And what do I mean by very near future? Well, I use different time windows. So I look at 0.1 seconds, 0.2, 0.5, 1, 5, and 10 seconds. The FX market is very quick, so there's no reason to worry about what will happen in 1 minute time. But say up to 10 seconds, which is a human can easily sort of comprehend and trade with. So what are the results here? The results look like this, and these are in millions of euros. So the idea is that, suppose I want to, if I submit a sell order in this market, on this platform, within 0.1 seconds, the buy order volume increases by 0.1 million. And likewise, if I submit a buy order, the sell side increases by 0.1 million within 0.1 second. So this sort of is consistent with the idea that algorithmic trading is good for liquidity, because if I submit an order, that will almost immediately be matched by more liquidity on the other side of the order book, which is a good thing. However, if you look at what happens after 0.1 second, so 0.2 to up to 10 seconds, you see that those are all negative. So this actually means exactly what my trader colleagues were saying, that the liquidity disappears when you put something in on the platform. So non-technically, we can sort of summarize this, that a new limit order immediately adds liquidity or creates more liquidity on the other side of the limit order book. And this is good, of course. That sort of shows that high frequency trading is a good thing. On the other hand, when humans have had time to react or even see it, it's already worse. And as you might know, people normally say, or psychologists normally say, that it takes 0.3 to 0.4 seconds for a human to blink. So obviously, a human cannot react to something that happens within, say, 0.1 or 0.2 seconds. So generally speaking, regardless, again, whether you are a human trader or an algorithmic trader, this is something you need to be aware of. There is a difference here in terms of time. And there was also a speech a year and a half ago by the former Fed chairman, Janet Yellen, about algorithmic traders. And she didn't talk about the FX market in particular, but I thought this talk was very good by her, because she mentioned the fact that the willingness to support liquidity is uncertain, and that is something that has changed in the FX market over the last 10 years. That yes, we have a lot of turnover, we have a lot of the volumes are still very, very large, but what do we actually mean by supporting liquidity? So I think it's important to have a look at the price-based liquidity, volume-based liquidity, and speed-based liquidity, regardless whether you are a regulator or a market participant, because this type of liquidity is changing. So, as we have seen so far, it's very easy to be tricked by liquidity, simply because you're blinded by the large amounts that everybody's talking about when you talk about the FX market. You talk about trillions and trillions, but in reality, maybe it's a lot less, and that is something important. But it's not only about that. There are also orders in the market that are directly contribute to a distorted view of the liquidity. And I would mention three different ones that are sort of linked to how we as humans perceive liquidity. And there are split orders, spoof orders, and ping orders. Split orders are those that are intended to hide market moving information. So in this case, it would be about slicing up a big order into many small orders. The reason being is that, of course, if you submit a large order, that will be picked up by other traders as, oh wow, this will definitely move the market. Therefore, they cancel their orders. So a split order is really intended to hide an information-rich order. Nobody's really, this is not perceived as something controversial. It's quite standard, and other market participants would not see this as rude if you submit a split order. A spoof order is intended to create a false impression of the state of the market, and spoof orders are illegal in many markets, and they were made illegal in the US, I think it was 2011, and also in many other stock markets or exchange-traded markets. And in some jurisdictions, they are not illegal, but they might still be considered as fraud. But I would say in general, they are considered as unethical orders. And then you have ping orders. Ping orders are intended to extract hidden information about the market. These are normally not considered as controversial, but it depends on who you ask. Some would say that they are completely meaningless. Some would say that they are creating a lot of problems, and some would say, well, they don't really care. So ping orders are less controversial. Let's start with split orders or order splitting strategies. If you look at the stock market, or if you read sort of journal articles about split orders in the stock market, you'll see that they would normally say that a split order is an order that is done within an hour or a couple of hours, that is sliced up in pieces. If we look at the FX spot market, we have to be much more conservative when we define a split order, because the market is just so big and so active. So in this case, this is a paper that I've co-written. We use a very, very strict definition of a split order. So that would be an order that is sliced up into pieces, of course, and the price has to be the same. So if I want to sell at 120, all of these split orders would have to be done at 120. The direction has to be the same way. So of course, if I want to buy, these orders would be sliced up into buy orders. They would also have to be submitted within less than 0.1 seconds of each other. And nothing in the market can happen in between these two split orders on the platform. So I'm using an extremely conservative measure of a split order. And using this, you might say, well, with this definition, there can't really be any split orders in the market. Well, here are the results, and for the 5 currency pairs I showed before. So these are again the 5 currency pairs from euro dollar to dollar against Turkish lira. The blue ones are independent orders, as I call them. So they are not split orders, and the red ones are split orders. And you have small, medium, and large orders. Small is $1 million or euros. Medium is 2 to 4 million euros or dollars, and large are anything larger than 5 million. 5 million or larger. So as you can see, for euro dollar and dollar yen, it's between 15 and 20% are split orders on this platform during those 3 trading days. So it's very substantial. Think about it, it's probably around 200 billion euros worth or $200 billion worth of euro dollar and dollar yen that are split orders, even if you use such a conservative definition. For the other currency pairs, almost nothing. I'm also looking at size versus price aggressiveness. So if you look at the small, medium, large, and then independent versus split orders again, so we can see that, for instance, for euro dollar, on a scale from 1 to 10, so 10 is a very aggressive price, and 5 is a non-aggressive price. So how are these orders submitted? So let's start with the euro dollar. The light gray, and light blue orders there are, if you compare if you compare the gray one, that is roughly 6.5 versus 8.3, shows the independent and split small orders. That would be 1 million orders. You can see that the dark gray is much higher, so the aggressiveness is higher, showing that split orders are, generally speaking, much more aggressive. And the same thing goes with the medium-sized orders. So split orders generally more aggressive, and the same thing for large orders. So this will show that split orders are often used to not only to disguise a large amount, but also to allow traders or algorithmic traders, in this case it's 100% algorithmic traders because humans can't submit these, to enable them to submit more aggressive or orders at more aggressive prices. And something that we found out from using this data set as well is two interesting things. One is that in the equity markets literature and also sort of old FX literature, it's normally sort of people think that if you submit a large order, you would normally not choose an aggressive price level because that will move the market. We find the complete opposite here. So it's actually very common for large orders to be very aggressive. It's more common than you think. And the second thing that is more sort of relevant for algorithmic traders is that the reaction to a split order is much stronger than a reaction to a typical human order. So a typical human order would be, say, a medium-sized order, 2 to 4 million, whereas a split order would be 2 to 4 1 million orders. The reaction by others is much stronger to a split order. So what we find here is that it seems that other algorithms are picking up that this is a split order and this is sort of an order that is intended to hide information. Therefore, we react to it very strongly. So in a way, you can say that these order splitting strategies aren't that successful. Now, moving on from this, we can also look at the spoofing. Spoofing, of course, is almost impossible to know if an order is a spoof order or not. You really have to ask the trader what was the intent behind this spoof order. But what we do as well, and what I've done recently, is to figure out which markets are illiquid markets more likely to be sort of susceptible to spoofing or not, because sort of if you talk to people, they will normally say that, yes, spoofing cannot be done in large and liquid markets like the euro dollar or dollar yen markets. However, in obscure markets, maybe such as ruble or Turkey, it is possible to spoof the market. We actually find the complete opposite here. So we don't find any indications of spoofing in the smaller markets. However, what we do find is that the big markets such as euro dollar and dollar yen are extremely sensitive to information-rich orders. So if you submit an order in the major currency pairs that could potentially move the market, other traders will pick it up very fast and they will cancel their orders, which is exactly the idea behind spoofing. It is to submit something in order to trick other people to cancel orders. So again, if you look at spoofing, you have to be very, very careful. If you believe that, okay, this could be a spoof order or not, it's not necessary that is only relevant to illiquid markets. What about pinging? Well, pinging is to submit an order or maybe a string of orders to the electronic platform to see if something happens. If nothing happens, the order is immediately cancelled. So you might think, well, why do traders submit ping orders? The logic is like this, that if nothing happens, well, then the trader or the algorithmic trader can extract some hidden information, because sort of testing the water a little bit. What will happen if I submit an order? And then you can change the level of price aggressiveness, or you can change the amount to actually see how sensitive is the limit order book to new information flow. Again, the same way as with spoofing, it's very difficult to know if an order is a ping order or not, and without asking the trader. So, but we can create proxies, and what I've done is to create a proxy just to get an idea of how prominent is pinging in different markets, in FX markets. And here, the logic I use is this, that if an order is cancelled before anything happens in the market, so before the price has changed in the market and before the volume at the best bid and ask has changed, then it is a potential ping order. It's not necessarily a ping order, but it's a potential ping order. So if I submit a price, submit an order, and nothing happens, and I cancel it before something happens, that could potentially be a ping order. Now, are there many of these orders in the market? Yes. So using exactly the same database, I worked out how many could potentially be ping orders. Now, look at the PPO. It's the second row from the bottom there, the potential ping order. How many for the different currency pairs are such potential ping orders? It's about almost exactly 10% in the euro dollar and dollar yen market. And so 10% sounds quite a lot, but when you move over to the euro Swedish, you see it's 50%, and in the dollar ruble market, 80%. And have a closer look at the second column there as well, is the lifetime of these orders. So how long on average do these kinds of orders stay in the market? In the euro dollar market is 3.4 seconds. In the Japanese yen market, 5.3 seconds, and so on. So they stay there for a very short period of time compared to orders in general. So if you look at the third row from the bottom, the average order in the euro dollar market stays there for 44.9 seconds and about 1 minute and 20 seconds in the euro dollar yen market. So pinging might be actually quite prominent, and the interesting thing here is that they seem to be more prominent in the markets that are less traded on this platform. So in the ruble market, which we know from before that no trading took place at all during these trading trades, 80% are potential ping orders. So that would be submitted by traders only to figure out if something is happening if we submit this order. You can also be more conservative here and select the ping orders that have a very short lifetime. So PPO underscore 0.5 are those that have a lifetime of less than half a second. So these would be orders that are guaranteed not submitted by human traders, because a human trader he or she doesn't have time to submit and cancel his order. And you can see in the dollar ruble market, 78%. So what we can see from here is that the ruble trading on this platform, it looks to be very, very large if you look at the total liquidity, but there's no trading going on, and almost 80% is probably ping orders by algorithmic traders. So that is something you need to bear in mind if you study liquidity, that there are many ways to study it, and one thing is to look at these different strategies and also work out the lifetime. So to sum up, what are the sort of implications and takeaways from all of this? I think one thing that you need to bear in mind if you are interested in being involved in the FX market, or if you already are, is to remember that it has a history of liquidity provision that is based upon conventions among humans. And that convention is based upon reciprocity and trust, human trust. And this, of course, is changing. There's nothing you can do about it. This market making function, especially in the FX spot market, is changing towards being more and more done by algorithms. So regardless, again, whether you are a regulator, a compliance officer, or a trader, this is something you need to be aware of, that the liquidity, as we used to see it, or how it's described in the textbooks, is definitely changing, and you need a wide range of metrics to assess whether an FX market is liquid or not. It's not enough to simply say, aha, this currency pair is ranked number 1 or number 8 in the BIS statistics 3 years ago. You need to go in on every single platform and check every single currency pair. And the second implication is about these various order strategies, that there is quite a lot of research done on the equity markets regarding split orders, spoofing, and also pinging. But and the logic should, in theory, be the same in the FX market. However, as you can see, the design and the prevalence, the impact on the liquidity can be vastly different in FX markets, even though the FX market is much, much bigger than the stock market. And that is also something you need to be aware of. The world is basically more complicated than you think. Again, so regardless how you submit orders or how you want to figure out how others are submitting orders, this is something you need to be aware of. So I also put up these recent articles, all very fresh, from 2018, and some are working papers that includes most of these graphs or slides that I've used here, if you want to read up more. But I really want to thank you for listening, and I look forward to your questions. Thank you so much, and over to you, Garuma.
Thanks a lot, Dr. Stenfors, for such an insightful session. I sure learned quite a few things. Now, we will begin with Q&A round shortly, but before moving into the Q&A round, I would just like to talk a little bit about QuantInsti initiatives that might be useful for few participants here. Okay. First one would be our flagship course, that is Executive Program in Algorithmic Trading, commonly known as EPAT, which is world's first verified certification offered to professionals and students looking to enter or grow in the algorithmic and quantitative trading industry. Now, we also launched an interactive self-paced learning portal known as Quantra, which offers more than 20 plus courses, including momentum trading and FX. With the vision of becoming a global knowledge and technology powerhouse in this domain, we have also launched Quantra Blue Shift, which is in its alpha stage as of now, but allows you to convert your ideas into strategies and backtest them for free. So don't worry about that. And guys, have a great rest of your day, everyone. And thanks for joining. Thank you so much.